Welcome to the basic investing and trading psychology lesson. This lesson is one of the most popular ones in the Fundamental series for good reason. It's probably one of the most interesting. It's about you and me, and it's about how our brains interact with the financial world around us. In this lecture, you should be able to understand how the mind works and some of the pitfalls that we face as investors. After all, our decision-making abilities are the very things that separate the profitable people from the unprofitable people. So understanding this stuff is very, very critical from a foundational standpoint. So let's get into it. First thing to understand is that everything happens in the mind. 100% of the activities in the market happen through your cognition. You only press the button one time, and that's to actually place the trade. So that's the moving of the finger, whatever it is. If you press it on the phone, or on the computer terminal, you only do the one little finger, everything else happens inside the brain. So making sure that the brain is aware of all of its own pitfalls and all of the beneficial ways that we can manipulate our own cognition in order to get the best decision-making capabilities. This stuff is incredibly important, so you can begin to see why understanding the mind is so important. Every thought that we have is being filtered through all of our previous experiences, all of our brilliance, all of our stupidity, all of the different biases that we have that we've developed over the course of our whole lives. Everybody is slightly different, but at the same time, everybody has the same instinctual pitfalls. And so we'll go into those in a minute. The first and most important rule of investing and trading psychology is that the human mind is not built to trade or invest by its default settings. The human mind is actually meant to fail at this activity by default without training. The reason being is because the prefrontal cortex in the mind, the bit that's responsible for critical thinking, spends most of its time actually reverse rationalizing the emotions that are suggested to it by the amygdala, which is the center of emotions in the brain. If you've never been consciously aware of this process, or if this is your first time hearing this, then you're probably in the 99.9% of people who have actually spent their whole lives thinking that they're thinking, but they're actually rationalizing their emotions and their feelings to make it seem like they're in control of their life. This is nothing to be ashamed of. It's literally the way that humans are programmed. It's the way that we've evolved. It's the way that we've been selected throughout all of human history in order to make the best decisions possible for us in the real world that we face. However, reverse rationalizing decisions isn't a good way of making good, statistically valid probabilistic decisions when it comes to value creation in the market. For this reason, you'll find that everybody that tries to instinctually figure their way through the markets, actually they don't make any money at all because they're completely untrained and they're trying to approach the market using what they perceive to be logic from the rest of their lives, which has always worked, but it's a completely different activity in trading. So your brain needs to actually be in a completely new phase of thinking in order to survive in the markets. They don't think to completely change the way that their brain processes thoughts, which is actually why everybody fails at trading in the first place. To make matters worse, even when you're aware of this problem, under conditions of fear, uncertainty, doubt, fear, or greed, the brain actually prioritizes the processing of emotions rather than the processing of logic, which means that during the times where you need the most rationality, the brain generally is prioritizing something completely different, which makes it even harder for humans to focus in on the right decision to make, especially when times are at their worst or at their hardest. This is the reason why developing a sound strategy and a rules-based system is so critical for us as humans, because it actually affords us the ability to step back and not allow our emotions to affect our decisions. People think that they can do this with sheer willpower alone, but at the same time, they're just relying on the brain. Whereas if you rely on something that's completely external, such as a rule set, it actually affords you that disconnection, which allows you to become a better trader. So here you see the 5 cognitive dimensions of mental models. This is such a fantastic way of displaying all the different mental models that people use when it comes to investing. Now, down here at number 1, we have instinct. This is where most people believe they are, and you can see by this line that I've placed here on the screen. This is my approximation of the amount of people who actually are using each level of cognition in their investing and trading. So instinct, I believe most people approach the market from a level of instinct. This is hard-coded reactions and things like emotions and generally just things that don't even make any sense. Like they're just kind of guessing and doing random shit. This is most people when they join the market. They believe that the holy grail of investing and trading is just to be able to somehow derive the position of the market from magic. The next level up is faith, which is mostly made up stuff. This is the level at which people, they think that they know a little bit, or they've heard of some things, or maybe they're just blindly following like a single piece of news. This is still not much better than instinct, and even fewer people use this. This is where fantasies and realities mix together in a disgusting mix, and people generally make huge fucking mistakes here. So we want to always be trying to get as far up this ladder as possible. Now, preference, where ego runs the show. This, even fewer people use preference. Now, this is where you have lots of different information at your disposal, but instead of choosing to approach it from a rational and maybe balanced perspective, you're selecting one or two pieces of information that you believe to be the best, or maybe you have a certain emotional connection to them, and you're just using these bits of information. This also is not very useful for us, because if you have just one or two bits of information, you never know whether your selection of those bits of information was biased or not. Next level up, which is even fewer people, is logic, where people are actually deducing rationality and logical outcomes from the market, where they're trying to use genuine information or qualitative analysis to determine what is the best move to make in the market. This is very good, and this is where most people really aspire to get to in their trading. They aspire to be thinking with logic and rational thinking. This is the difference between number 4 and number 1 and 2. See, most people come into the market and think that they begin at number 4, when in reality, they start at number 1 or 2. Now, this is due to an enormous lack of humility and an enormous lack of respect for the complexity and danger for the activity that they're actually embarking on. Number 4 is actually very difficult to get to. Number 4 is, the equivalent of a whole bunch of experience and a whole bunch of very good quality information that is at your disposal at all times. However, that is still not the best possible dimension of cognition that you can get to. Evidence base. Empirical evidence and a tested model, a tested simple, maybe something that is rules-based. That is the superior level of cognition that you should be striving towards in trading or in investing. My approximation down here would say that very, very few people, if anybody at all, makes it into the top echelons of the cognitive dimensions of investing and trading in this respect. To the best of my ability, I have always tried to be up in the top right-hand corner along with evidence. However, we can always afford to do better. Sometimes maybe I think that I'm in number 5 when in reality I'm in number 4. But we always are trying to get to the best possible position in this chart. So after looking at this chart, you can see how important it is to be humble and to approach the market from the right standpoint. We always begin thinking that we know it all. Typical, and we always want to be getting up into the top right-hand corner in the upper echelon of thinkers. We want to be using the best parts of our brains in order to approach the market. Failure to do this is going to leave you bloodied and in a mess in the gutter. You're not going to know what happened because you were never making any logical decisions to start with. So it's very, very important to us to get to a stage of empirical evidence. This chart here, the Wall Street cheat sheet, is a cult classic. This one is different to the previous slide on cognition. This is something completely different. We'll go through it step by step because this is a fun one, and generally it's quite accurate as well. If you see these effects moving through the market, then generally you kind of know where in the market cycle you're at. Human psychology is a great way of understanding where the market is so that you can make the best possible move, but only if you know how to counter trade it. So in the Wall Street cheat sheet, you can see that we start out generally in a bear market at disbelief. We will move into the hope phase eventually, but only after people are not even believing that it's possible. They'll move into hope and they'll go, oh man, maybe it's actually happening after a long period of death and destruction. And then it'll keep going up, it'll keep going up. Oh my God, the rally is real, it's optimism, and their enthusiasm starts to increase. Belief, time to get fully invested. Thrill, I will buy more on margin. I've got to tell everybody to buy. Euphoria, I'm a genius, we're all going to be rich. complacency, we need to just cool off for the next rally. Now, this is the point where everybody gets fucked over. This is the point where everybody thinks we're going to go for the next leg up and we'll go even higher than the previous one. This is where everybody gets trapped. And then as we go down, people are starting to draw trend lines down across here over to the anxiety phase, and they go, why am I getting margin calls? This dip is taking longer than expected. Maybe it'll bounce off this imaginary trend line that I have going up through here. And then it'll go down to denial. My investments are with great companies. Surely they'll come back. Panic. Shit. Everyone is selling. I need to get out. Capitulation. I'm getting 100% out of the markets. I can't afford to lose more. At this point, people are absolutely distraught. They are suffering and everybody's just obscenely upset. Anger. Who shorted the market? Why did the government allow this to happen? This is the part where people go out with their pitchforks and their torches and they go hunting for people. Right into the extended bear market and into the depression. My retirement money is lost. How can we pay for all this new stuff? I am an idiot. And after everybody is flushed out and all hope is lost and everybody has finally got themselves removed from the market, then the accumulation begins from people with very long time horizons. People with very deep pockets come in to collect up a bargain, and we move into disbelief yet again. And the market cycles between the points of maximum financial opportunity to maximum financial risk over and over and over again. Over many different cycles, we have this same recycled fear and greed, and it happens over and over and over again to infinity. A fascinating point to remember about the markets when we go through these different emotional cycles is that these cycles can actually operate over all different time horizons. So whether we're talking about many months to years where we have a full cycle, or whether we're talking about maybe hours or maybe days, and it's a very short time horizon pump and dump. These different effects can happen over all different time horizons. So if you're a short-term trader, you're going to be feeling these same emotions over very short periods of time, whereas long-term investors are going to be feeling these emotions over the course of years. Knowing that this is the way the human mind works and that this is a good way of calibrating our expectations, we can often see this in the market and we can use this to our advantage. And this is where a lot of different sentiment-based indicators come from. That's more complex, and that's the discussion on how we actually use this effect to make more money. But this is just an introduction. So we'll continue on with the presentation and we'll look at that further in the university. So in the next part of this presentation, we're just going to quickly cover a few of the different cognitive biases and the cognitive errors that people go through when they're in the markets. A big part of the reason why we suffer from these is because the human mind is a master at energy conservation. The brain consumes so much energy from the human body that its job is actually to shut off a lot of the rationality in the brain so that we can resort back to very easy problem-solving heuristics that are inherent in our own mind. So one of the ones that we're starting off with here is anchoring. Anchoring is where, for example, and we'll use a market application. Anchoring is where you have something and you stick to it. In finance, this is like if we're having a negotiation and I say, well, I'm willing to sell you this pen for $100. And then you say, oh my God, no way I'm paying $100. I'll pay $50 for that pen instead. And I'm like, you know what? That sounds like a good deal. I'll give you this pen for $50. In reality, the pen costs $2, but we anchored ourselves way too high. And the same thing happens in the financial markets. When you invest in a cryptocurrency, it doesn't matter what price you buy in at, but you are anchored to that particular price. You form an emotional connection with that price, almost like you form a relationship with a person. You'll press the button and you'll know what price you got in at. You'll be thinking about that price. You're anchored to that price. But nobody else knows. The market doesn't know. Nobody else cares. The market doesn't care either. You're the only person in the universe that cares about that price, and the market is going to continue doing whatever it wants to do, regardless of your entry. Whether you're in profit or loss, it doesn't mean anything as far as good analysis goes, where the market is going next, and what your positioning should be. This is closely related to the sunk cost fallacy. The sunk cost fallacy is the mistaken belief that by persisting with a certain course of action, you can actually retrieve the losses or the issues that you had previously in the past. This is like the belief in chess that you can suddenly take back your positions, or being obsessed with a move that you made 10 moves ago, and you're like, oh, that was a mistake. Maybe if I move this piece from this square to this square, I can make up for that previous mistake. Not understanding that you cannot go backwards in time, and everything in the past actually doesn't exist. The only thing that we have is the current moment forwards. Everything else that happened in the past, every decision that you made, may have not existed. Certainly, we use the past as educational material. We use the past data, we use past understandings in order to inform us, but not in the sense that we go and try and use our decisions forwards to make up, to compensate for previous decisions. That is the sunk cost fallacy, and it's related to anchoring, like I mentioned. Prospect theory, loss aversion, and the disposition effect explain the effect where people actually require twice as many gains to compensate for 1 unit of loss. For example, if I took away $10 from you, and then I gave that same $10 back, you would actually still feel like you were in a deficit because of the emotional damage that I caused to you. You can see how in trading, this wouldn't make any sense. This is not a rational relationship. The relationship numerically between profit and losses is quite simple to understand. It's just numbers. It's linear. However, the mind does not perceive it this way. The human mind is incredibly averse to losses. We hate losing things. For this same reason, people have a very strong loss aversion effect, which means that they try to avoid pain as much as possible. You can see now that if we are in trading and we are in investing and we're taking our positions, this means that we're not making an equally rational decision when our positions are in profit to an equally rational decision when our positions are in a loss. These will not be under the same cognitive frameworks. You'll actually be operating under different cognitive frameworks for both of these. This effect obviously messes with your decision making to a very high degree and is probably one of the most dangerous cognitive effects that the human mind can suffer from in investing and trading. Herding is another big one. This is where people only feel comfortable participating in a certain course of action as long as there are other people also doing the same thing. This comes from an incredibly weak mindset, and you'll find this very often with new people into the market. They will often try and pass their decision-making capabilities through a consensus filter of some sort. So they will go into the chats and they'll ask, hey, what's everybody buying today? What's everybody selling today? Hey guys, I heard that there's some danger in the market. What are we doing? What we are doing doesn't mean anything. What everybody else does doesn't actually affect the outcome of the market, not unless it's a data collection activity for the sentiment effects that we spoke about earlier. For this reason, most people actually take a course of action and they believe that it's better to fail conventionally than to try and do their own things and fail unconventionally using their own analysis. They don't want to feel like they made the wrong decision. If a group of people went out there and made money, and then they made a decision and they didn't make money, they would feel stupid. And that would fuck with their mindset. And then they would be like, oh, well, now I feel very guilty and I'm going to participate in the group activity next time around. You can see that I'm using the word feel a lot. This is a common effect. People feel feelings in the market and they try and attach this to groups to make themselves feel better. Feelings are not useful. People will use their emotions for all different types of things in the market. Recency bias. Recency bias is the effect where people will take a certain piece of information that has happened only in the very short period of time that they've been investing, and they put disproportional amounts of weight on that. A certain favorite indicator that they've just discovered triggers, and it gives them a really good entry or a really good exit in a certain coin, or it gives them a right call, but throughout history, it's been questionable. They will then place all of their trust and respect in this one particular indicator, despite knowing historically that it's not that accurate. However, their recency bias is compelling them to trust this thing far beyond what they should rationally be trusting it, because of its track history. This same thing happens all the time as well. It's like if the market moves down in a certain way, people expect it to do that same thing again. People often call these effects fractals. You won't see me teaching fractals in this university because I do not believe in them. I think that it's just fucking something that people made up in their minds. It's essentially recency bias put onto the charts for everybody to see. Confirmation bias. Confirmation bias is where you come into the market with a certain perspective and you go out there and you cherry pick certain information in order to confirm your views. You can see how this is pure insanity. The idea of approaching investing and approaching the market is not to have a bias. The point is to approach it neutrally and then let the evidence tell you what to do. Confirmation bias is one of the most deadly things in the whole world. Sure, you can form a bias if it's through maybe another system. Maybe you can have two database systems and you can have a very long-term system and a very short-term system. So if the very long-term system gives you a long bias, then you go and apply that to the short-term system. Therefore, when the short-term system tells you to buy, you're more inclined to listen to it than when it sells to sell. Vice versa. So this is where confirmation bias within a systematic and rules-based method can be beneficial. Confirmation bias in a psychological manner, where you are forming an expectation just from derived fantasies or egos or faith. Any of these things, they're going to damage you in the long run. Mental accounting. Mental accounting is where people put different amounts of money into different psychological buckets, regardless of whether or not these things are the same value. For example, this is a great example. Your grandma gives you $100 and in your bank account, you have $100. That $100 that your grandma gave you now suddenly in your mind is worth more than the $100 that you had already saved up in your bank account from doing chores around the house, if you're a kid, for example. Therefore, you're going to treat this $100 differently to the $100 over here. But that's not correct, is it? Because dollars, by definition, are fungible, which means that they can be combined together and you can't tell the difference between them. They both have an equal amount of utility and they can be used for the same things. It's only within your psychology that you believe that these $100 are somehow different to each other. This can get scaled up to infinity. You have different sub-accounts in your portfolio and you have $100,000 over here and $100,000 over here, but somehow you believe that this amount of money needs to be safer than this amount of money over here because there's a delineation between the two accounts. None of these things should be put into their own buckets. It is your entire net worth that needs to be viewed as one big coherent mass. All of the value, all of the wealth is its own thing. It's all together as long as everything is liquid and it can be all utilized for the same purposes and it's not being locked away behind a magical key. It's all the same thing. There is no such thing as one group of money being more important than a different group of money, okay? It needs to come from the very highest levels, top down, understanding that portfolio construction comes from a point of entire net worth. So in conclusion, you can see that the human mind is absolutely riddled with cognitive biases and heuristical errors, and we have only just scratched the surface. There are hundreds and hundreds of different cognitive biases. These are faulty decision-making pathways in the human mind that have been bred into us through generations, through hundreds and thousands of generations. Our job is not to try and overcome these necessarily because they cannot be turned off. Our job is to understand they exist and to identify them when they arise in us so that we can do our best to try and avoid them. I do not believe to the best of my abilities that you can out-train these effects. However, you can always work around them. This is why rules-based systems are so important in trading and investing. If you look at the chart that I've posted on this screen right now, you can see that the effects of everybody buying low, selling high, and letting their emotions get the better of them is probably one of the most dangerous things in the market. Take a good look at that and have a bit of a laugh because holy shit, it's one of the most funny things I've ever seen and it's super true as well. So remember, hope is not a strategy. Emotions are not a strategy. What you feel is a completely and utterly irrelevant piece of information. The only thing that matters in the market is logic and empirical evidence. If you'd like to explore further education on this subject, We have our Advanced Philosophical Principles lecture in the investing lessons, the Psychology Masterclass, and if you want to read a book on the subject, Daniel Kahneman's Thinking Fast and Slow, I believe, is the best book on the subject, absolutely. So, in summary, do not hope the market goes up. Do not hope the market doesn't go down. Do not hope it goes in any direction, up or down, side to side. Do not hope. Do not use feelings. Feel nothing. Remember, your feelings are an utterly useless piece of information, and you should never be using your feelings in order to make decisions in the market. Super important to remember this, and absolutely use your systems and your rules to avoid any of these negative effects. And with that being said, thank you for listening. I'll see you in the next one.